We've been systematically dissecting Dr. Horton's latest earnings call, analyzing data from America's largest home builder, and CEO Paul Romanowski revealed something that fundamentally changes everything we thought we understood about this housing market. The specific words he used should genuinely terrify every American who owns property or plans to. This is how the collapse starts. But he wasn't referring to what you're probably thinking. Here's what's keeping serious analysts awake at night. What's generating genuine concern among those of us who study market mechanics deeply. While everyone remains fixated on watching for a 2008-style dramatic price crash, for that spectacular implosion where values plummet 30 or 40% seemingly overnight, there's a hidden mechanism that's already been triggered, and it's going to systematically paralyze the entire housing market in a way we've genuinely never experienced before in American economic history. But before you panic and make emotional decisions, we discovered something buried deep in their financial data, in the footnotes and margin calculations that most people never examine, that reveals exactly how to position yourself strategically to not just survive this structural collapse, but potentially profit substantially from it. The numbers we're about to methodically walk you through prove conclusively that the Homebuilder CEO was absolutely correct in his assessment. This is precisely how the collapse starts, but it's not starting the way anyone expects or has been conditioned to recognize. Here's what's actually happening beneath the surface headlines and why everything you think you know about this market, everything the mainstream financial media has told you, is fundamentally wrong. If you're a prospective home buyer sitting on the sidelines waiting for prices to crash dramatically before you enter the market, you're missing the real story unfolding right now in real time. If you're a seller hoping to time the market perfectly, waiting for that ideal moment to maximize your return, the window you're anticipating might never actually materialize. And if you're an investor or long-term renter, the data we're about to systematically walk you through changes everything about your strategy for the next 12 to 24 months. Moody's Analytics chief economist Mark Zandi just escalated his official warning from what he described as a yellow flare to a red flare for the housing sector. His exact words, worth analyzing carefully: home sales, home building activity, and even house prices themselves are set to slump significantly unless mortgage rates decline materially from their current near 7% level soon. Here's the smoking gun that everyone's completely missing while they focus on surface level statistics. 38% of builders cut prices in July, up dramatically from just 29% in April. That's a massive increase in just 3 months. But here's what's truly confusing analysts and defying expectations. Prices aren't collapsing. They're going sideways, stagnating. And that creates the most dangerous scenario imaginable for everyone involved in this market: buyers, sellers, investors, and the broader economy. Let me walk you through exactly what's happening with specific numbers that'll genuinely shock you and challenge everything you thought you understood. But first, let me fully resolve what the CEO actually revealed during Dr. Horton's quarterly earnings call, because his language matters enormously. CEO Paul Romanowski made what can only be described as a chilling confession to analysts and investors. The incentives are up significantly, as we've spoken to repeatedly. That's precisely why we guided to a noticeably lower gross margin heading into the fourth quarter. Let me translate that corporate speak into plain English that reveals the underlying reality. America's largest home builder just openly admitted they're bleeding money, sacrificing profitability, trying desperately to attract qualified buyers in an environment that's turned hostile. They're voluntarily cutting their own profit margins just to move houses, just to maintain sales velocity. When the biggest, most sophisticated player in the entire market admits defeat publicly, when they acknowledge they can't maintain previous margin levels, we're in genuinely uncharted territory. Housing starts and building permits are already at levels we typically only see during recessions, during periods of significant economic contraction. Meanwhile, completed units from home builders continue increasing steadily. Translation for those not steeped in construction economics: builders are finishing homes they cannot sell while simultaneously refusing to start new construction projects. Dr. Horton's quarterly revenue dropped 3.2% to $9.7 billion, with full-year revenue down 6.9% to $34.25 billion. Those are substantial declines for a company of this scale. But here's the truly revealing detail that exposes what's happening. Their actual home closings, the number of transactions completed, fell only 1% to 23,368 homes. Think about what that means. They're selling almost the same number of houses, but generating dramatically less profit per transaction. They're maintaining volume by destroying margins. Current mortgage rates are crushing demand at multiple interconnected levels that compound on each other. The total median cost of homeownership now approaches $4,000 monthly when you include the $21,400 annual additional cost beyond the mortgage itself, insurance, taxes, maintenance, utilities. That's up 18% from just 1 year ago. Now compare that crushing number to renting a typical single-family home at $2,200, $96 monthly. That's over 40% less expensive than owning. That's not a small difference. That's a fundamental economic incentive driving behavior. And here's where the situation gets truly interesting and reveals the hidden mechanism. Over 80% of homeowners are what analysts call out of the money, meaning their existing mortgages carry interest rates at least 100 basis points, 1 full percentage point below current rates. Many are locked in at rates 2, 3, even 4 percentage points below today's rates. This creates what we call a lock-in effect that artificially suppresses supply by making it financially irrational for homeowners to sell. Now let me address the elephant in the room, the question everyone's asking. You're probably thinking, won't prices just crash dramatically like they did in 2008? Won't we see that same spectacular collapse? This is where everyone, including most professional analysts, gets it completely wrong. And here's that hidden trigger mechanism I promised to explain fully. The hidden trigger that's about to seize up the housing market that's going to create paralysis isn't falling demand as everyone assumes. It's what economists call the golden handcuffs effect, and it's unprecedented in scale. Listen to this mechanism carefully because it's counterintuitive. Over 80% of homeowners are effectively trapped. Their existing mortgages carry rates so far below current market rates that they literally cannot afford to sell their homes because they'd lose their ultra-low interest rates. Even if they want to move, even if their life circumstances have changed, the financial penalty for giving up a 3% mortgage and taking a 7% mortgage is absolutely crushing. This creates a supply freeze that prevents the normal market correction mechanism from functioning properly. When supply can't respond to falling demand, prices don't crash, they stagnate. And stagnation might actually be worse than a crash for many participants because it creates uncertainty and paralysis. Former President Trump is already publicly blaming homebuilders for artificially keeping prices high by sitting on empty developed lots, by restricting supply deliberately. And you know what? The homebuilders are pushing back extremely hard against this characterization. But here's why prices won't collapse in the traditional way you're expecting, the way that would make buying easier. A comprehensive study from the National Association of Home Builders found that nearly 25%, a full quarter, of the price of a typical newly built single-family home is directly attributable to regulations imposed by state, local, and federal governments. Environmental reviews, zoning restrictions, building codes, impact fees, the regulatory burden is enormous. If land use regulations were meaningfully relaxed at multiple government levels, an estimated additional 2.5 million housing units would likely be added over the next decade, eliminating approximately 2/3 of the estimated national housing shortage. But here's the problem. That regulatory reform is politically difficult and slow. It requires coordination across multiple levels of government. It faces opposition from existing homeowners who don't want new construction in their neighborhoods, so that supply relief isn't coming quickly. Meanwhile, Trump's 10% tariff on lumber imports adds $720 to the cost of an average home. Tariffs on kitchen cabinets and vanities lift costs by roughly $280. All told, current tariffs are adding approximately $8,900 to the cost of building an average home. Those costs get passed directly to buyers. The Federal Reserve has repeatedly overlooked this critical red flag in previous economic cycles, and they're making the same mistake again. When housing permits and housing starts decline together simultaneously, residential construction workers often lose their jobs at some point in the near future, typically before the broader economy officially enters recession. Housing employment is a leading indicator that precedes broader economic trouble. Here's where we deliver on that promise about the hidden opportunity that could potentially save you tens of thousands of dollars if you understand the timing and mechanics. Remember how I explained that Dr. Horton's profit margins are getting systematically crushed by the incentives they're forced to offer? Here's your strategic opportunity if you understand how to exploit it. Builders are so desperate to move accumulated inventory that they're offering rate buydowns, where they essentially pay points to reduce your mortgage rate, closing cost assistance that can run into tens of thousands of dollars, and outright price cuts like we haven't witnessed since the 2008 financial crisis. But unlike 2008, and this distinction is absolutely critical, they're offering these incentives from a position of relative financial strength, not existential desperation. In 2008, builders were on the verge of bankruptcy, over-leveraged, facing immediate insolvency. Today, their balance sheets are relatively strong. They're profitable, just less profitable than they want to be. This means the deals they're offering are real, sustainable, and available right now. But they're only available while builders are actively trying to clear inventory before the next building season begins. Once that inventory clears, or once they decide to hold rather than discount, these opportunities disappear. Now let me walk you through exactly and specifically what this complex situation means for your individual circumstances based on whether you're a buyer, seller, investor, or renter. If you're looking to buy, looking to enter the homeownership market, listen carefully because this might be counterintuitive. We've been analyzing this market, professionally for years, studying cycles and patterns, and we've genuinely never seen builders this willing to negotiate, this motivated to make deals happen. Dr. Horton's CEO admitted openly that this year's spring selling season started slower than expected as potential homebuyers have been substantially more cautious due to continued severe affordability constraints and declining consumer confidence. Translation from corporate language into reality. They need you more than you need them right now. The power dynamic has shifted. Current advantage for buyers. Inventory is steadily building up, giving you negotiation leverage you haven't possessed in years. But here's the critical window, the timing element that matters enormously. Once builders collectively decide to stop offering these aggressive incentives, once they choose to hold inventory rather than discount it, you'll be paying full price plus higher interest rates. The opportunity window is finite. If you're thinking about selling, if you're a current homeowner, considering putting your property on the market, we need to be absolutely straight with you about the reality you're facing. Your window of opportunity is narrowing with every passing quarter. When Moody's chief economist explicitly warns that home builders are giving up on offering rate buydowns because it's simply become too expensive, too margin crushing, and many builders are actively delaying their land purchases, pushing back their pipeline development, that tells you something critical. The spring selling season that everyone was counting on, that traditional peak selling period, isn't coming the way it historically has. The hard truth you need to accept. If you've been seriously thinking about moving, about upgrading or downsizing, you need to act now or plan realistically to wait 18 to 24 months for potentially better conditions. The market isn't going to get easier for sellers anytime soon. The supply-demand dynamics are shifting against you. If you're an investor, if you're looking at real estate as an asset class for wealth building, here's what the genuinely smart money, the institutional players and experienced operators are doing right now. They're focusing almost entirely on cash flow over appreciation potential. When construction activity slows down dramatically as it's doing now, that means fewer new rental units hitting the market over the next 12 to 36 months, which means rental demand pressure persists even if home prices flatten or decline slightly. Supply and demand still matters in rentals. And here's an angle most smaller investors are completely missing while they focus on single-family homes. Smaller regional builders that grew 25% annually in recent boom years are now extremely vulnerable to cost overruns and project delays due to persistent labor shortages and material price volatility. These companies expanded rapidly during good times and now face challenging conditions. This creates significant opportunities for larger cash-heavy investors to acquire distressed projects to pick up partially completed developments at substantial discounts. If you're currently renting, if you're not yet in the homeownership market, we've got genuinely mixed news for you that requires careful analysis. The good news, The positive development, more inventory is slowly coming online as builders complete projects already in their pipeline. The challenging news, the frustrating reality, there's a 12 to 18 month lag, a significant delay before rent relief actually hits your personal wallet in a meaningful way. While single-family homeownership costs are approaching $4,000 monthly when fully loaded, renting that same property type averages $2,296. That's approximately a 40% cost savings right now today. Our professional advice based on analyzing these cycles, stay patient for now. Start proactively negotiating with your current landlord using market data. But don't expect dramatic, substantial rent drops until late 2026 at the earliest. The supply relief is coming, but it's delayed. And here's where the analysis gets really interesting again, where we find opportunities that others miss. The national averages that everyone discusses, that the media constantly reports, they're actively hiding the real story unfolding in specific markets. Let me break down exactly where the opportunities and dangers are geographically concentrated, because your specific zip code, your local market conditions determine everything about your experience. If you're in Texas or Florida, if you're in those major Sunbelt growth markets, you're actually in a relatively good strategic position compared to other regions. These Sunbelt states have been home to America's largest, most aggressive home building companies. And here's what we're observing in the data. Steady, consistent construction over recent years has kept home prices more reasonable relative to incomes compared to coastal markets. In some Texas and Florida cities, prices are actually dropping year over year in real terms. Why is this happening when national prices remain elevated? Texas specifically doesn't have statewide zoning laws, which makes building new homes dramatically faster, cuts through bureaucratic red tape. Translation into practical impact: more supply coming online, better prices for buyers, more options. We've been consistently telling people for months that the Midwest and Northeast regions are offering the best relative safety right now for buyers, more moderate price growth, stable demographics without wild speculation, and none of the overheated conditions we've observed elsewhere. But if you're in Phoenix or Dallas, if you're in those formerly red-hot growth markets, listen carefully to this warning. These were the spotlight growth markets everyone was talking about, where appreciation seemed unlimited. But we're projecting with significant confidence they could see appreciation rates drop below 2% annually in 2025 and possibly turn negative because of inventory gluts, because supply is overwhelming demand. That's not necessarily bad if you're buying, if you're trying to enter the market. But if you're sitting on property hoping for continued strong appreciation, counting on equity growth, you need to adjust your expectations dramatically. Here's what the comprehensive data shows us clearly. Construction of single-family homes dropped significantly in recent months. Every single indicator for new residential construction, permits filed, starts initiated, completions finished, all down compared to last year's levels. When we see builders pulling back this aggressively and unanimously, when we see that kind of coordinated retreat, it tells us they collectively know something the general public doesn't understand yet. They have forward visibility into demand that consumers lack. Look, after spending weeks systematically diving into these detailed earnings reports and comprehensive market data, analyzing footnotes and management commentary, here's our bottom line assessment. The real collapse, the actual structural problem, isn't happening in nominal home prices the way most people expect. It's happening simultaneously in buyer confidence and builder profit margins, and honestly, that specific combination creates exactly the conditions that smart buyers, sellers, and investors can exploit for substantial advantage if they understand the mechanics. Let me be completely direct about what we would personally do if we were in your specific shoes, if we were making these decisions ourselves. If you're looking to buy, if you're ready financially and emotionally for homeownership, stop waiting passively for rates to magically drop back to 4%. That's not happening anytime soon without a severe recession. Lock in those rate buy-down deals with builders right now while they're bleeding margins, trying to move inventory. We've genuinely never seen builders this motivated to make deals happen. If you're thinking about selling, if you're considering listing your property, understand that every quarter you wait, your leverage and negotiating position decreases. Don't chase perfect conditions that may never actually materialize. The market is telling you clearly through multiple signals to move now if you're serious about selling. If you're investing, if you're building a real estate portfolio, forget completely about property appreciation for the next 2 years minimum. Focus entirely and exclusively on cash flow, on rental income exceeding expenses. With construction slowing down dramatically, rental supply stays tight. That supply-demand imbalance is your opportunity. If you're renting, if you're not yet ready to buy, be patient, but start negotiating proactively. The rent relief is coming. It's in the pipeline. But it's going to take 12 to 18 months to really hit in a meaningful way. The housing market is experiencing structural paralysis, not a traditional crash. And for those who understand that critical difference, that's exactly where the opportunity lies.